Hello, everyone. On behalf of the Counselors of Real Estate, welcome to this special presentation of Dynamics of Mature Markets in East Asia, featuring members and a special guest of our Asia Pacific CRE chapter. Thanks for joining us. I'm Noah Schlaze, CRE Emeritus. The Counselors of Real Estate is a distinguished, solutions-focused consortium of accomplished advisors addressing real estate challenges worldwide. Experienced, innovative, principled, and credentialed problem solvers, counselors reside in 22 countries and practice in many more, and offer expertise in 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation. Let's take a second to recognize the sponsors for this event, Equus Capital Partners and the Real Estate Limited Partner Institute, RELPI. Thank you for your partnership. Before we begin, we'd like to offer you a free digital subscription to the Counselor's peer-reviewed professional journal, Real Estate Issues. It's been named one of the top 10 essential real estate publications in the U.S. Please visit cre.org/REI to subscribe. In this second session of a series of Asia-Pacific webinars, we'll turn to South Korea, Taiwan, Hong Kong, and China to assess the real estate markets, economies, and political systems of these diverse and culturally rich countries. This session has been pre-recorded due to the fact that we're spanning something like 14 time zones to bring this to you. Today, I'd like to introduce our host, Hiro Isobe, CRE, and fellow with Japan Valuers Company Limited in Tokyo, Japan, and the founding chair of the Counselors of Real Estate's Asia Pacific chapter, now with 15 members and growing. Welcome, Hiro.
Thank you, Noah. Good morning and good evening, everybody. Thank you for joining the second APAC webinar hosted by the series Asian Pacific Chapters. I'm Hiro Isobe and the chair of the APAC chapter. East Asian region consists of Japan, China, South Korea, North Korea, Taiwan, and Mongolia. Hong Kong and Macau are politically part of China currently. Today, we focus on South Korea, Taiwan, Hong Kong, and mainland China, which have achieved a big economic growth. Looking at the world ranking for GDP based on the IMF 2024 statistics, the United States is the first, obviously, followed by China, and Japan 4th, South Korea 12th, Taiwan 22nd, and Hong Kong 39th. Meanwhile, in terms of per capita GDP, the US is 7th, Hong Kong 20th, South Korea 33rd, Taiwan 37th, Japan 38th, and China 74th. In addition, the World Competitiveness Ranking of 2025 was recently announced by the International Institute for Management Development located in Switzerland. It shows another interesting figures. According to it, Hong Kong is ranked at second, actually next to Switzerland. And Taiwan 6th, US 13th, China 16th, South Korea 27th, Japan 35th. As you see, the gross volume economy is not the only measurement to represent the economic power of the countries. Today, I'd like you to learn more about the current dynamics of the market in these matured Eastern Asian countries that have been closely tied to the US economy. Now, let me introduce today's moderator, Dr. Stephen Bass. Steve has been living in Japan for about 20 years and has worked with various real estate firms in Tokyo. after receiving PhD degree in urban planning at the UCLA. Currently, he is a director and head of Japan investment in Link Real Estate Partners, Tokyo office, which is one of the largest investment groups in the world. He became the CLE last year. Now, Steve, can you start the session?
Thank you, Isobe-san, and hello, everyone. We have three distinguished panelists today representing major parts of East Asia. First, Sumi Koo in South Korea, Winston Shi in Taiwan, and Joseph Junior Ho in Hong Kong, covering Hong Kong and China. So hello, so welcome everyone, and I'd like to start the panel discussion. Let's start with Winston Shi, covering Taiwan. Winston, if you could please start by introducing yourself.
Hi, everyone. I'm Winston Shi, and I'm so pleasure to attend the Asia webinar. And then I'm mainly located in Taipei, Taiwan, and I'm certified appraiser in Taiwan. And then I just got a CRE last year and attend the forum last year in New York. And I mainly focus on commercial real estate market. And then in Taiwan, I have over 17 years experience in appraisal and then consulting field. And let's talk about Taiwan. Taiwan actually have 23 million people. And then our main language is Chinese. But we attend to learn the English from our childhood, like my children, and they learn English right now in school. And we have a different religion. We have a freedom of election, religion, and then we have two parties of our sorry. Sorry, I started this page. Okay. Let's talk about Taiwan. And we have 23 million people in Taiwan, and our main language is Chinese. And we tend to have a bilingual language in Taiwan right now for education. And we have a good a destination for the global travelers. So Agoda statistic, Taiwan ranks 6 at the top of the 10 market in Asia. And we have a good location for the logistic. We have a 2 to 4 hours flight to the main cities in Asia, like Hong Kong, like Korea, Japan, and even Australia. Actually, we have a good transportation system, like a high-speed rail. And from the north to the south, we even have a 90 minutes. We can go from Taipei to Kaohsiung. And we see the main airport. We have a Taoyuan International Airport and then Kaohsiung Airport. And we have a good export for our goods manufactured in Taiwan. And we have a major global logistic company like DHL, FedEx, UPS set hubs in Taiwan, mainly in northern Taiwan. Talk about the economy. Actually, we are strong at the semiconductor area and then goods for the high-tech industry. And the government set up industrial park back in the 1980s. So mainly we have a Hsinchu Scientific Park, and we established Central Taiwan Scientific Park and right now Southern Taiwan Scientific Park. Our famous company TSMC, they announced that total they will have 14 factories in Taiwan. So it's the main driver for the Taiwan economy. For the company, we have like an overseas company invest in Taiwan, and like above 80% of company, they are local companies, but they are strong for their products like computer, like high-tech goods. So like in Hsinchu, we have a total over 600 companies. In Central Taiwan, over 200, and Southern Taiwan, over 200. And we have a good research team to support the R&D field. And except the semiconductor, actually Taiwan, we go for the net zero environment, and then so we are like attract wind power or solar power companies from Europe. They invest big money in Taiwan. And we also care about the healthcare field and then EV field. There are big names investment in Taiwan like NVIDIA. And actually CBIE do the transaction for their office leasing. And ASMO, they have land in New Taipei City, and they will build factories. And let's have an overview of Taipei City, because Taipei City is capital of Taiwan, and we have a different area. One is the Xinyi area. Xinyi area is in the east of the Taipei City, and there's the Taipei 101 located. So that's most populated and commercialized area. And the second area is Taipei Main Station area. And right now, Taiwan, we have a twin tower that will be finished in 2026 and 2027. And that will have a big supply for the office. And we have a good transportation, because in Taipei City, many people have scooters, but we have a good MRT system. And many people take the MRT to the office. And right now, Taiwan's housing market, the prices are going too high. So we will many people will take MRT like above 30 minutes to 1 hour to the Taipei City to work. Let's have an overview of economy. And actually, in the past 5 years, we have like a 4 to 5 GDP growth. So it's look quite healthy of Taiwan. And our inflation control is quite good, it's at 2%. And what I mentioned about is the housing market. Actually, it's 2024. But if you see the 2025 actually is going downward, because we have a little bit have a bubble phenomena. So the government just control the LTV like a loan for the investor. Like you buy the home, you have a 80% LTV, but you buy the second home for the investment purpose, you only have a 50% LTV. So the control for the LTV makes the housing market going downward right now. And for the Taipei office market, actually, we have a big supply in 2026, 2027. So we can see the rental will going a little bit downward, the bargaining power for the tenant will going stronger. Yeah, and then we see that if the office, you have the lease or have a well certificate, and it will attract overseas tenants to the building. So the old building, they will go into the regeneration to rebuild. And that's a Taipei office district. And then what I just mentioned, that the Taipei 101 is in the eastern location, and Taipei Main Station in the west. So you can see the total stock, and then our grade A office rental is like above like 3,500 NT dollars per pin per month. And for the vacancy rate, because the Taipei main station have a twin tower, so the vacancy rate will going higher. But in the long run, that we see that the total market is like a 3 to 5% vacancy rate right now. And for the investment turnover, that actually we declined by 15% year to year in Q1, because the land market is not good. The biggest buyer is the construction company, and then they tend to wait and see. So you can see the chart that actually for the average, we have a 250 billion NT dollars per year. And then during the COVID-19, actually, we induced many overseas Taiwan company come back to Taiwan. And we have an initiative for the low interest rate, or the government help them to buy the land or seek for the suitable area. So we can see that the dark green is for the land volume is quite high, and then with the good like assets to the loan. But right now for the 2025, we see the whole market is going to conservative. And for the industrial only, and then we put it to three factors. One is industrial land, and the other is factory, and another is for the industrial office. So you can see that in the past 5 years, the land is going higher, but right now the land is because of the scarcity of supply, and then the land volume is going to lower. And I talk about Taoyuan because I just mentioned that Taoyuan just nearby the airport, international airport, and the harbor. So the many logistic company, they buy the land to build their modern logistic center in Taoyuan. So we can see that except for the logistic, many like insurance company, they build to suit a factory or income producing properties in Taoyuan area. So insurance company, they dominate the market in recent years, but they have the minimum rate of return right now for like 3%. And some developer also buy the land to build a industrial factory, but if the location is too suburban and that's not attracted to the tenant. And another portion is self-use, and they just build their own factory for the self-use. For the logistic market, and we can see that the point I dot, that the dots is logistic factory, and either modern, either traditional properties, and they are all in the northern Taiwan and Taipei City, just nearby the Taipei City and nearby the transportation. And then we can see the orange line, they are highways. So in Taiwan, we have 2 highways from the north to south, and then they just scatter nearby the highway. I just divided land and the commercial property. For the land, construction companies in Taiwan, they dominate the market. They just buy the land and construct it and then sell to consumers or like a whole block to investors. So construction company, they buy the land, do this business. For the commercial, actually in the past, the insurance company, they if the rental is good and then the cap rate is above 3%, and they just to buy the property. But because the tariff and then the currency rate of the Taiwan dollar, and they just stop to invest in recent years. And self-use corporate, they buy the office, they buy the factory for self-use. And this chart, we can see that actually we have the minimum cap rate for the insurance. and because they are big, very big investor in Taiwan, 2.545. But actually, they will be increased. So actually, we talk about the minimum rate for them is 3.2%. And recently, and then because in Taipei, there are no property like above 3.2%. So they're going south, or they going to the different market like logistic, and even right now data center in Taiwan is the potential property in Taiwan. And I just show the cap rate in Asia, and Taipei for the Grade A office in core location is like a 2.1 to 2.8, but in Taipei City, what I see is just 2 or 2.2. But in maybe in other big city, it's like a 2.8 to 3%. But in decentralized area, it's above 3%. And for the shopping mall in Taipei is 2.5 to 4%. And in the neighborhood area is like close to 4%. For the logistic in Taipei City is 3.1 to 3.5. But if it goes southern, and we can see the cap rate is going higher. And recently, our company just done the deal. And the seller is overseas company, and they really want to sell the property. So the lease back, the cap rate is like above 4.5%. And for the traditional logistic facility is 3.45% to 3.85%. For the property type, is the office, industrial office, and factory very average for the investor. But right now they want like a flight to quality property, because the old one they cannot comply with some emission or local regulation to the net zero policy. For the location, Taipei City or New Taipei City or Taichung City, they dominate the market. In Taiwan, we have 6 major urban city, and the property activity all located in 6 major cities. And for the yield, and we see that because the environment is going risky, and then potentially maybe central government will rise their interest rate. So our yield will going higher for the forecast. So finally, I will say that the property, they were located in good area, and then the building is new, and they will seek for investments appetite. And then a self-use market is dominate right now, because investment players like an insurance company or REITs, they will stop their investment right now. And NVIDIA, Jensen, he just announced that their overseas headquarters located in Taipei City, they call the NVIDIA Constellation. So yeah, I think I live in Taipei, and then I love Taipei, and then I think Taipei will attract many talents or many high-tech company to invest in Taipei. So that's my presentation, and if you come to Taipei, and please contact me. Thank you.
Great. Thank you, Winston, for that presentation. We have some questions that we'd like to ask you in regards to your presentation. So are you ready for a few questions?
Yeah.
Okay, great. First question. Under the Taiwan registration system, are the land and building to be registered separately, or only land to be registered? And is the normal tenure fee simple?
Okay, for the registration is very strict. So the people, if the building have a ownership of the land and building, and then they will register together. We cannot register splitly. Yeah. That's for Taiwan.
Oh, okay. Thanks. Second question. Is there any restriction against foreign ownership in Taiwan?
Yeah. Foreign people can buy the property in Taiwan, but we have like a reciprocal agreement with 77 countries, like including United States, United Kingdom, South Korea, Japan, and Malaysia, like that. But other than the 77 countries, they have some restriction for their people.
Okay, thanks. Are you referring to taxation or ownership? Ownership?
Ownership, yeah.
Okay, got it. Okay, understood. Third question. When Foxconn and TMSC announced plans to build new factories in Taiwan, did the local real estate market have a significant impact? Second part of the question, in Japan, when TMSC opened a huge factory in Kumamoto, land price in the local market rose by 20 to 30% in 2024 due to the increase of various demands in the surrounding area. So I guess the question is, do we see something similar as a result of the Foxconn and TMSC announced plans?
Yeah. I just went to Kumamoto last week for business tour. And actually in Taiwan, we see the phenomenon that around by the TSMC, the housing market is going higher. But that is under the environment of a low interest rate. And then we have a pre-housing system. But right now, government, they control the situation. So actually, the pricing is going like over two times. But right now, the market is cooling.
And that's talking about Taiwan. Right?
Taiwan, yes.
Yeah. Just for the viewers' information, Kumamoto is in Japan. It's in southern Japan. Yeah.
So Kumamoto, I think we observed that actually above 50% are Taiwanese investor, Taiwanese construction company or individual investor. They go to Kumamoto to duplicate capital gain in Taiwan. So they want this investment successful.
Okay, great. Well, thank you, Winston, for that presentation and for answering the questions. We'll now move to South Korea. And Sumi, if you could take it from here. I'll also similarly start off with a self-introduction. That would be great. So thanks. Take it away. Thanks.
Okay, thank you. First, I will share my PPT. Okay, my name is Sumi, and I'm a certified appraiser based in South Korea. I have been involved in the valuation and consulting of a wide range of real estate assets, especially for legal proceedings and institutional proposals. I also currently serve as one of the vice presidents of the World Association of Valuation Organizations, WAVO. It's an honor to be here today to share insights into the South Korean real estate. Yes. Let me begin with a brief overview of the country. South Korea is located on the southern half of the Korean Peninsula in East Asia. With a population of around 52 million, it is one of the most densely populated countries in the world. Major cities include Seoul, Busan, Incheon, and Daegu, with the Seoul capital area alone accounting for nearly half of the population. South Korea is a democratic republic and has grown into one of the world's most advanced economies. However, as you may know, its democracy was recently tested when a former president attempted to impose martial law. We responded by impeaching the president and electing new leadership committed to protecting democratic values. I'm so proud of it. Economically, Korea ranks among the top 15 globally, driven by strong competitiveness in manufacturing, information technology, and innovation. The country's rapid urbanization and world-class infrastructure have played key roles in shaping its real estate market. With that national backdrop in mind, so let's now take a closer look at the real estate market, beginning with the residential sector. As May of 2025, South Korea's residential real estate market is undergoing a cautious recovery following a significant correction. The market today reflects regional disparities, shifting demand patterns, and continued government interventions aimed at stabilizing affordability and housing supply. After a sharp downturn in 2020, when nominal home prices fell by 4.68%, the market stabilized in 2023 and began showing signs of recovery in 2025. As of February 2025, the Bank of Korea's nationwide house price index posted a modest year-on-year increase of 0.31%. However, when adjusted for inflation, this still represents a real-term decline of 1.67%. Seoul metropolitan area is leading the recovery. Seoul's housing prices rose by 3.63% year-on-year, while regions outside the capital experienced their third consecutive year of price declines, especially larger regional cities. In terms of activity, about 640,000 residential transactions were recorded last year, which is a 15.77% increase from the previous year. However, this volume is still 22.8% below the 5-year average and nearly 50% lower than the peak reached in 2020. The capital region, especially Seoul, is at the forefront of the rebound with the 45.15% increase in transaction volume. Residential construction remains subdued. In 2024, about 450,000 units were completed nationwide, a 3.16% year-on-year rise. Meanwhile, housing starts jumped by 26.07% to over 305,000 units, primarily driven by public housing initiatives. Nevertheless, this remains below the government's estimated annual demands of 450,000 units, leading to a projected shortfall of around 500,000 units by the end of 2025. The rental market has recently stabilized. According to the Korea Real Estate Board's Integrated Rent Index, nationwide rents rose by 1.2% in March 2025. Apartment rents increased by 1.65% compared to just 0.5% for row houses and 0.2% for detached homes. In Seoul, the average monthly rent for one-bedroom apartments reached approximately $1,000 this year. Foreign ownership continues to rise. As of mid-2024, foreign nationals owned about 95,000 residential units, which is 8.98% increase year-on-year. Chinese nationals held the largest share, 56%, followed by Americans, Canadians, and Taiwanese. Roughly 69% of these properties were located in the capital region. To curb speculative demand and soaring prices in affluent Seoul district, the government reintroduced tighter trading regulations. As of March 2025, purchases in districts such as Gangnam, Seocho, Songpa, and Yongsan require local government approval and are restricted to primary residence purposes. Mortgage rules have also been tightened, especially for multi-home owners. In October 2024, the Bank of Korea cut its base rate by 25 basis points to 3.25%, its first cut in over 4 years to stimulate the economy amid slowing domestic demand. However, concerns remain about potential property bubbles, and some policymakers advocate caution regarding further cuts. Looking ahead, the housing market is expected to continue its gradual recovery led by capital reason. However, regional disparities, limited supply, and regulatory challenges remain persistent concerns. Let's now move on to the office real estate market. Seoul's prime office market is anchored in 3 major business districts: the Central Business District (CBD), Gangnam Business District (GBD), and Yeouido Business District (YBD). These areas form the core of the South Korea's commercial real estate activity. CBD, around Jongno, Uljiro, and City Hall, is home to government agencies, legal firms, and financial institutions. Though the buildings are older, their prestige and central location maintain high demand, especially from law firms and traditional finance. Gangnam has evolved into a tech and innovation hub, housing AI startups, venture capital firms, and international offices. Its modern buildings, business ecosystem, and transport links make it popular among younger firms and foreign investors. Yeouido is Korea's financial heart, hosting the Korean exchange, major banks, and asset managers. As the location of the National Assembly, it also holds political significance. Its transformation into a mixed-use zone enhances its long-term appeal. Key demand drivers for office space include finance sector. Domestic and international financial firms seek premium Class A office space with modern amenities and reputational value. Second is the tech sector. The digital economy continues to fuel demand, especially from AI and IT firms located in Gangnam. Also, foreign investors. Multinational companies prefer well-certified, sustainably built offices near clients and regulators. Together, these forces are reshaping demand for Korea's premium office market. Turning now to the retail and logistics sectors. The rapid rise of e-commerce has driven major investments in logistics hubs, especially near Seoul and along highway corridors. Companies are expanding distribution infrastructure to meet growing demand for quick, efficient deliveries. On the retail side, traditional department stores are giving way to mixed-use complexes blending retail, residential, and leisure functions. There's also growing interest in experiential retail, where shopping is integrated with entertainment and dining. However, compared to logistics, growth in retail remains modest due to evolving consumer behavior and economic uncertainty. Let's briefly touch on the hospitality and healthcare sector. This sector is benefiting from growing domestic demand and Korea's expanding medical tourism. Real estate projects such as hospitals, wellness centers, and specialized clinics are attracting investment, supporting Korea's ambition to become a regional healthcare hub. The trend is toward integrating hospitality and healthcare infrastructure for both local and international patients. Let's now turn to the investment market and REITs. Institutional investors like pension funds and asset managers remain highly active, favoring income-generating assets such as office towers, logistics facilities, and mixed-use complexes. Although Korea's REIT market is still small compared to other developed countries, interest is growing. REITs are becoming increasingly attractive due to their liquidity and portfolio diversification. As regulatory frameworks strengthen and market transparency improves, REITs are expected to become a more prominent investment vehicle. Next, a look at the Korea's legal real estate framework. There are 5 key pillars. Mandatory registration of all land and buildings ensures legal clarity and trust in transactions. Transparent ownership structure with a detailed title records supports security and due diligence. Open foreign investments with only limited restrictions on farmland and military zones. Strict zoning and urban planning laws govern development and land use. A regulated financing system where property appraisals are required for mortgage issuance and household debt is closely monitored by the government. Now let's highlight some unique features of Korea's real estate system. 전세 system, a lump sum lease where tenants pay a large deposit instead of monthly rent. Though declining in popularity, it still affects housing prices and rental supply dynamics. Government regulation. Korea is known for its active intervention in the housing market through tax policies, lending rules, and supply-side programs. ESG and green buildings. Sustainability is becoming a core focus. Developers and investors are increasingly aligned with ESG goals and benefiting from government incentives for green certified projects. South Korea offers a dynamic and policy-driven real estate landscape. Government actions, legal clarity, and advanced infrastructure combine to create a resilient environment for investment. Despite challenges like regional disparities and supply constraints, Korea presents strong opportunities in residential, office, logistics, and healthcare sectors, with growing momentum in sustainable and institutional-grade real estate. It's a market where global trends meet local innovation and one well worth watching in the years ahead. Thank you for your attention.
Great. Thank you, Sumi, very much for that presentation. We do have some questions, so if you're ready, are you ready for some questions? Okay.
Okay, I hope so.
Okay, fantastic. First one, we understand that there are and you've already touched on the listed REITs in South Korea. We understand that there are 24 listed REITs. Do you think that the market will see further growth, and are global players active in the REIT market?
Yes, as I mentioned it briefly in my presentation, institutional investors like pension funds are increasingly drawn to REITs for their liquidity and portfolio diversification. So this interest is further bolstered by strengthening regulatory frameworks and improving market transparency, making REITs a more prominent investment vehicle. Consequently, global players are also actively investing, targeting these same attractive income-generating properties. So the South Korea REIT market, though currently smaller than in developed countries, is poised for significant growth.
Great, thank you. Second question. I think you've also touched on this in the presentation. Are global investors active in the investment market? And has overseas investment by domestic institutional investors been increasing, especially given uncertainty in US markets?
Yes, global investors are very active across South Korea's investment market, including real estate and stocks. Furthermore, domestic institutional investors are significantly increasing their overseas investments as well. Korea's net overseas investments recently surpassed, as I know, the $1 trillion, driven by public funds, seeking alternative assets and companies investing in global high-tech industries. This trend continues as strategic diversification and long-term goals often lead to overseas investment even amidst uncertainties in markets like the United States.
Great, thanks. Okay, continuing on, because we have two more questions on the list. Declining population and aging problems in Korea are now becoming as significant as they are in Japan. How do you see the residential market affected by these trends?
Yes, South Korea's declining population and rapid aging, similar to Japan, profoundly affect its residential market already. And long-term, overall housing demand is expected to decrease as the younger population shrinks. There's also a shift towards smaller, more accessible housing units catering to an aging population. Although there are concerns that an aging population could lead to declining real estate prices, we are still struggling to find effective solutions to this complex challenge. We haven't yet discovered a definite way to mitigate these potential impacts and are actively seeking viable strategies.
Okay, well, we'll continue to look at that just as we are here in Japan.
Yeah.
Definitely monitor that.
Yeah.
Last question, and also you've also mentioned this in the presentation, chonsei, the lump sum system. How does that affect the financing, liquidity, and pricing of residential assets?
Chonsei is a very unique system in Korea. It acts an interest-free loan, providing landlords with the significant capital to pay off mortgages or acquire more properties, reducing their reliance on bank loans. The fully refundable nature creates high liquidity risk for landlords, especially if chonsei prices fall, making it difficult to return deposits. For tenants, it locks up substantial capital. So the chonsei system's interest is declining in popularity nowadays.
Yeah, that was going to be the follow-up question. You see it changing over time, becoming less prevalent over time? Is that right?
Yeah.
Great. I guess this, in and of itself, chonsei could be a topic for a webinar in itself. So anyway, thank you so much for that presentation, Sumi. Thank you.
Thank you.
So now we're going to move to Hong Kong and China. Junior, if you're with us.
Yeah.
Okay, please take it away.
Yeah, sure. Thank you. Hello, everybody. I'm Joseph Jr. I'm based in Hong Kong, but I practice in the valuation of properties in Hong Kong and China, as well as I'm also a urban planner, so I also involved in the development industry, in the real estate industry in the Hong Kong as well. So let's move in Hong Kong. I hope everybody had to visit Hong Kong before. Hong Kong is quite a tiny city, part of the China. It's just about 1,100 square kilometer, which almost equal to 1.4 times of the New York area. So in particular, we have about 7.54 million population in Hong Kong, which is quite dense. We're talking about 7,000 people per square kilometer. And official language is Chinese, Cantonese, and also English, but we always speak about Mandarin. And our currency is Hong Kong dollar, which pegged to the USD. So when you look in Hong Kong, we have, although there are quite a density, but actually our urban area is just about 25-26%, with almost 40% of the land are country parks, which are not permitted to develop. So in particular, actually we do not, and all other areas are quite hilly. So actually we got quite at scarce land resources in Hong Kong. And we look at the GDP, we focus mainly in the finance as well as some of the service industry. But if we talk about the real estate and construction, you can see that it's a slightly drop starting from the 2018 to 2019, and then we were quite hit by the COVID and also the lockdown. Here are some of the economy and the statistics. So although that we quite have a valley GDP growth, which points to negative in the COVID times, but we are quite just be above 2% in the 2025, and our unemployment rate is quite low at just about 3%, but I think it's coming up to about 3 to 4% right now already. And the interest rate, because we Hong Kong dollar is pegged to the USD, so we interest rate also follow the Fed rates. So actually, we are just about the best lending rate is about 5 or 5.25% right at the moment, which is quite high when compared to previous time. And the visitors, yes, we are locked down. We faced a lockdown in the COVID time, but our visitors are coming back. We hope so, which try to boost the tourism industry. So if we talk about the Hong Kong, especially about the property market, I think the first come to my mind is about the least affordable housing market in Hong Kong. We always ranked the top among the least among different cities. Actually, according to a recent study, the average home price is about 25 times of the median income already. And actually, we are one of the least affordable cities in Hong Kong, in globally. And also, we are quite facing the housing bubble. Actually, we faced the housing bubble for almost 10 years already. So it goes back to different sectors. Let's say we have the residential, the mass residential, and the luxurious residential. We have the office, retail. We're quite strong in the previous time. And also we do have some of the logistic and industrial, because we are focused in the exporting, in the importing as well. And the hospitality, because we have quite a number of visitors within Hong Kong. So previously our hotel and the tourism is quite strong as well. And about the special market, which may go to the healthcare and educational, and also we have some of the risk development. But we go through it step by step. Here are some of the numbers that I think we may want to know about. So we have some of the price index. Actually, you can see all the prices are dropping down. We are not yet going up from the recovery. Both the residential, the office, the retail, and the factory price are all going down. And the property yield, actually, we are driving up. We reached the lowest in the 2017, 2018, which just about 2% or 3%, but it just rise up because we are looking for, investors are looking for a high yield due to the high interest rate. So I would say that we are, the overall property market is still going down, but we are trying to look for the recovery, because we investors are quite lack of the confidence. If it goes to the legal aspect, we have a land system as we inherit from the British government. All of the land are leased by government, which mostly with 50 years terms, and there is no restriction on the front ownership, but you just need to buy extra stamp duty for the front buyers. We quite have clear legal framework about the property. We have governed by the government lease, the planning and the building control. All the regulations are clearly written down and not easily to be changed. So in other ways, we are quite of a bureaucratic development control system that you need to go through step by steps. But it provides quite a clear development framework to the developers and all the investors. If we talk in the final aspect, I think that's the problems that coming up to currently. the developers, the investor raise money by mortgage, the loan, bonds, or IPO. But the lenders are facing quite a risk from the real estate exposure, because we are still facing a price drop in the overall property market. With the assets price, the assets valuation drops, the assets are quite not wealthy as like before. So the loan ratio or debt ratio is dropping down. So the developers are facing a default rates, whether they can go for another. Have you heard about we recently we have the New World? They're facing the loan issue, whether they will be default or not, and they are trying to secure a new refinancing loan. And some of the list, the Chinese developer are listed in Hong Kong that previously defaulted already. So we're quite facing some of the financial aspect in the risks in this aspect, which may pose lower confidence to the lenders as well as the investors. So it creates some kind of the liquidity crisis. And because the interest rate are quite quite high already, so the developers are really facing default risk in front. But there's still opportunities in this market. One of the quite niche investment trend is the educational related trend. Although we are in tiny city, but actually we have almost 8 to 9 universities in Hong Kong, which 5 of them are ranked top 100 according to different researches. And the government is doubling the admission quota for the non-local students up to 40% of the local quota. And there will be, and they are investing 1 billion of Hong Kong dollars in the scholarship schemes, trying to boost the education market. And we're going to develop a university town in the New Territories, which is quite far away, but we are trying to attract more education institutions to Hong Kong. So what came up next? We are targeting to have more student enrollments, and the existing supply of the student accommodation is quite low, and we foresee there will be quite a large shortage of the student accommodation. So many investors are coming to Hong Kong to convert the vacant office or vacant hotel into student accommodations. We are seeing various transactions in this year already, and government is going to have some new measures to try to boost this market. So and also with the coming up of the students, there are more space required. The university and all the educational institutions are quite the strongest buyer in the current market, because they're trying to expand the campus. So in that sense, the short or the medium term investment trend will be we target to be on the education related. And in the long term, I hope everybody will understand there will be a new plan coming up for the long-term metropolis in the boundary between Shenzhen and the Hong Kong. So there will be 4 different location hub where they will target to different positions. It comes across about 30,000 hectares in total, which is about 88 times of the Central Park in New York. Which, if all implements, there will be 500,000 job opportunities and 500,000 flats in total, which come up to about 14% of the current jobs and about 20% of the current residential markets. It's a huge development. Government trying to attract new investor, lobbying for the local developers to get involved. There will be opportunities inside, but because in these long-term developments, what our focus is about the implementation time frame, whether it will be get in line in 3 years' time, or actually need to wait for the implementation of the infrastructures. I think they pose quite a lot of the risks to the developers or the investor, And if you're talking about the for long-term loan, whether there will be a significant pattern assets or in the whether the Hong Kong economy is performing well. So that is quite of the bubbles in mind. But having said that, it's quite worth note long-term investment opportunity in Hong Kong. So I think that's a brief note about the Hong Kong market, and then we'll quickly shift to the mainland China. Official name is the People's Republic of China. It's about the world's third largest country. Hong Kong in the world. Population is about 1.41 billion in the world, and density is quite the population density is quite low, which is 153 person per kilometers, but we are quite an uneven distribution because of them are focused in the coastal area. They speak, we also speak about the Mandarin, the Putonghua, and the currency about the renminbi. Economy is the GDP is quite the largest, but actually the GDP per capita is not the top among the world. It's just in the upper middle income. The key sectors about the manufacturing, the technology, the infrastructures, and also before the crackdown will be about the real estate. But now we are quite facing a both inside. The stock exchange, we have the Shanghai, we have the Shenzhen, and also in Hong Kong, which are quite the focus. We have the A shares, the X shares, and also the Hong Kongs. If you talk about the housing market in the tier 1 city, let's say in the Beijing and Shanghai, the average price is talking about 60,000 to 100,000 per square meter. But we have a policy about the housing for living, but not for speculation since 2017, because we're trying to provide good living to the residents. So the government is trying to slow down the resident market bubbles. But actually, we are facing some of the key challenges, as we all know. About the ever-greater crisis, the local government have to create slow down the economy. We have quite a huge aging population, which about 40% are over 65, and it's quite raising up fast, and in the birth rate is not as high as we expected. And also we are facing some of the political economic crisis, let's say the trade war and the tensions. And we see from the graph, actually the sale of the new properties, both including residential and commercial, dropping down in quite obviously. We have the loans we expect to, because before in the 2001 to 2023, you can see that the loan is quite going up to quite a high level, but we expect to slow down because of some of the process, and also some of the prices that bring up already. And these are some of the figures. We are still trying to target to achieve a GDP growth rate of about 5%, but obviously we can see a slowdown already. The interest rate, although it shows to be slowing down too, but you can also see about the CPI changes. Actually, we are facing a slowdown after the COVID, although we have the internal demand, but in current times, the price is dropping down, the GDP is slowing, we are going through the recessions, and the stock market is quite remaining the stable. So these are some of the more figures. In the growth rate of the real estate development is all dropping down with a negative growth rate. We have quite a high unsold stock in the market. We have some of the price mismatch between the completed and the pre-sale residential units, which creates some of the problems between the existing buyers. And the land banks, because the developers are facing a crisis, so they are releasing out the land bank and so on. So actually the stock are going out and the market is slowing down. And in particular, you can look about the shares, we call the A shares. Although other sectors are performing in a relatively stable state, but the real estate sectors are facing a huge drop down in the 2024, and we expect to continue in 2025. The net profit and the gross margin are dropping. Actually, you can see the net profit, the percentage of those listed developers are going to the negative in the 2023 and 2024. So it's not a good sign for those for the real estate market. It's a huge area, but we also these are all the different sectors, because we have the residential in the tier one city should be quite resilient in the market, because they are still a strong supply trends from the urbanization. But in tier 3 and tier 4 cities, we always see a quite often unsold stock in the areas because of the previous oversupply. And the office and the retail also facing the oversupply issue. Although the stock may remain quite, the rent and the yield remain quite stable in the tier 1 city like Shanghai, Beijing, but going to the tier 2 or tier 3 or tier 4 city, the demand are not catching up with the supply. So actually we are facing up bubbles in those aspects. But we do have a good industrial and the logistic market because of the boost of the e-commerce, the fans from the apps, and then actually we are doing the industrial and the logistic market are doing quite good, and we have a boom in the industrial markets. And we also have the hospitality and data center and senior housing education. We trying to build up more data center, possible investing in the data center sectors, but due to some of the policy, those markets may not be quite right as we expected as before. About the legal aspect, we have the quite a complicated land system. The urban area is state-owned, which about 25 to 70 years lease, and the rural area is a collective ownership restricted for the transfer. And currently, the government is reviewing for the renewal of this lease term for the for the state-owned land in the urban area. So that may be come up to about paying a premium for the renewal. Restriction on the foreign ownership, yes. We do allow the foreign buyers to purchase market, but it's quite restricted. Let's say for one property in tier 1 cities, but and also have some of the public requirements, but it depends on the city's level management. So in some of tier 1 city may allow you to do that, but in some other cities may not allow it. And for the regulation of developments and buildings, yes, we have plenty of them. And actually, it's quite they're tedious of them, because we have the state level and also in the local government level. So you need to do legal due diligence before any transaction or development in China. We have different perspectives, let's say from the land administration, the building and construction, the rural land area, the urban renewal process. All of this require a full due diligence. So about the financing, still the same, the mortgage, the loan, the IPOs, and the rest. So when we talk about the special topics, I think we face a quite different markets after the Great Crisis and the local government debt, and also with the agenda of the housing for living and the aging population, the issues that we are trying to shift to do some improvement in the residential markets, but we are still trying to put the office and or actually on the oversupply issues. We have the significant process about the 3 red lines. We have the special bonds arrangement, the urban renewal, and also about the development of the REITs in China. The three red lines policy I introduced in 2020 with just targeting on the real estate development companies, because we want to lower down the liability to assets ratio and also the debt ratio in order to, because the government try to slow down the prices, but actually there are some of the penalties binding to the violations. But because of this policy, the government are trying the developers are trying to meet the targets, but then it fails because of the high leverage previously adopted by the developers. And so they face the liquidity issues in after the policy, and then it turns out to a huge crisis, let's say the upgraded debt, which result in the default on both onshore and offshore debt. And in the crisis, it creates of the credit risk issue, and then the government, and also going back into loop whether they are struggle to have a refinancing, and then they start to fire sale of their properties, and it creates a crack in the real estate market, which or reduce the assets price. And we need to know that the local government are relying on the real estate to boost the local economy. Previously, the major income are coming from the land sales. Without the land sales, it creates the financial problem of the local government. So it just seems like going back to the vicious cycle that cannot support the real estate development companies that are in crisis. So it's going through the loop and the loop. Notice of this problem, so the government tried to have some more policy going out to boost the market. Let's say they provide the tax subsidy for the first-time home buyers, which targets for those individuals with no existing properties, and they also release the restriction of the sales, the ownership, and also they put about the conversion, trying to commercial to residential conversion for those vacant projects, which aims to turn those unsold commercial properties that have been developed to convert to residential. But still, it brings some of the effects to the end user. But because of the oversupply issue in China, we are quite seeing a high vacancy rate, and the unsold units are still in the hands of the developers. Government is trying to turn out more measures. The local government are quite urged to put some measures out. Let's say in the Hainan province, measures promote the stable and healthy development of the real estate market. They adopt a dual approach to trying to boost the supply and demand side, and they also aim to have a high quality development. Or let's say in Chongqing, they trying to replace for those idle land plots, which cover quite a huge to about 20,000 miles of the land. So because they usually this part of land are purchased by the government, by the developers for the long residential use plots, but because of the low demand, they're trying to purchase the land plots back to help the finance of these companies, as well as to have a better urban development. So one of the significant policy aspects about the special bonds or special finance arrangement for the real estate, the local government, the central government allowed the local government to use some of the bonds for, let's say, for the completion of a special bond, which means there are quite of the upcoming residential or commercial projects that the developers are led to finance to move on. So they provide these bonds to help the developer to complete the project and so in the market. We have the new urban village redevelopment bonds, which just target other urban renewal problems to finance the developers to kickstart these hold on urban renewal projects. and also about the whitelist developer financing. These are the most generous policies that try to provide the funding to those in problematic development companies, while they still need to fulfill some of the requirements listed by the government. So you can see the local government is trying to the state government and the local government are trying to help these companies, because they create a vicious cycle of the real estate market as well as the local government. But one of the potential risks is about whether the issuance of such loans from the local government to the developers will create another problem, which further hitting the debt ratio of the local government, which also creates which brings back the prices to the local government. That's one of the potential risks that we need to look for. And about the urban renewal, because we may heard about the urban villages in the China's. In the tier 1 cities that are developed for more than 20 or 30 years, there are some of the still, because of the rate of the urbanization, the urban cities area stretches to the rural areas already and finally merges with these villages. There are some of the villages in the urban area quite old or trying to be developed. So the government is very looking for these urban renewal projects, trying to promote a good urban environment. Let's say focus on the 4 good development and make 8 major tasks covering the infrastructure, ecology, culture, and liability. There is strong start and the well-known waiting in the 2025, and we also have some of the ambitious annual targets. This about the urban renewal projects that are already going up in the tier 1 or tier 2 cities already, but it's a good move to reactivating these scarce resources in the cities. Well, there are some of the high profit margin because the compensation or the land price of this village area is not as high as in the other developed areas. But because of the long development period, there are some of the lockdown, there may be some of the lockup of the real estate financials or the capitals, which may create some of the prices in this coming as well. So the government is trying to provide some of the special bonds to boost this aspect. And it finally goes to the C rate because it's a special rate that consists of the infrastructures and the government projects, let's say the toll roads, industrial estate, or some of the domestic rental housing. It's quite interesting aspect because it seems the risk are resilient in certain level. We can see that the CSI, the risk price index for the rental housing sector, has surged about 30% in Q1 of 2023. The total return index for this industry rose about 30% during the same period. And you can see that the price trend of these domestic rental housing rates are going up, with the issue size expected to be higher in the upcoming years. So sorry, we do not have a lot of time to go through all of the aspects, but as a key takeaway, Hong Kong is still remain of the global liquidity hub. We focus on the luxury and also some of the special assets, but we are facing some of the crises from the lending and also some of the liquidity. While in the China aspect, it's still about the policy driven about the domestic demand. There is still an investment trend in the tier 1 cities, but when you look in the tier 2 or tier 3 or tier 4 cities, then you need to be cautious about the policy and the changes that we're going up. So I think it's just about the relationship in both markets. I mean, it just comes to my end of my presentation. First,
Okay, yeah,
can you-
okay,
Yeah,
thank you,
good,
Junior.
good, good.
Okay, I had a little technical difficulty.
No problem.
Okay, anyway, thank you, Junior, for that presentation. You covered a lot of material. Obviously, China is a huge market.
Yeah.
And we could have spent all day on it, but you've covered a lot, and thank you. So we do have some questions.
Yeah, sure.
Two each for Hong Kong and mainland China, kind of double lucky for each.
Sure, please.
Okay, for Hong Kong first, have investors from mainland China played a significant role in prices in Hong Kong real estate, in particular the until recently the price hikes?
Yeah. Actually, indeed, what I think about is that the local demand is still weak because there are previously the local investor or some of the funds they have facing some of the liquidity issues. There are some of the distressed assets or we call the fire sale already. But we are quite focusing on the foreign investor. Let's say from the mass or luxurious residential markets, we are targeting for the mainland investor. We have some of the talent program trying to attract them to come into Hong Kong to invest, and also of course to stay to boost the local economy. But about the institutional investor, I think they are quite still holding their bets because they are quite uncertain about the timing of the recovery of the Hong Kong market. But it's hard to tell because you don't know when the recovery will start during the recessions. So it may be good timing to invest, but be careful about the liquidity and the default rates. I think that's the most important part.
Okay, all right, thank you. Second question is more maybe kind of a macro, a zoom out kind of question. Have you seen any changes in Hong Kong's financial hub position after being returned from Britain to China in 1997?
Wow, that's a quite tough question. But about the function of the global financial hub, I think it doesn't change because the finance market still remains the finance industry still is a key pillars of the economy in Hong Kong, and we are also facilitating all rounds of the financial instruments and also the funding in the world that they use the Hong Kong Stock Exchange or some of the transition markets in Hong Kong. But we can actually see a shift in the list company, while the previously we have all other kinds of the countries coming or companies coming from over the world into Hong Kong for the listing. But we can see that there is a significant portion of the mainland companies going to list in Hong Kong because of maybe some of the tension between the US and China that they try to delist from the US stock market and going up in Hong Kong. So I think the function of the global financial hub is still remain the same, but we are just shifting the focus.
Okay, thank you. Okay, moving to mainland China. We have two additional questions. You've mentioned Evergrande in your presentation, Junior, but here's the question. After Evergrande crisis and local government debt issues, has the government established a publicly subsidized company to take over non-performing loans from financial institutions, such as the RTC, Resolution Trust Corporation, in the US in the late 80s, and RCC, Resolution and Collection Corporation of Japan, in the late 90s?
Yeah, I from my understanding, it's not quite such arrangement because although there are some of the state-owned asset management companies or holdings in China trying to focus on this loan, but actually though for those NPL, I think the Chinese government is just as I mentioned, they issue the special bond arrangement for the local governments to tackle this problem because there's some risks if it shift all the NPL to some of the state-owned companies. So they try to get the control by releasing the fundings from the government itself rather than those assets company. So I think the answer is no, but because we have some other issues. But whether these issues are effective or not, we are still looking forward in the coming years.
Got it. Okay, thank you. The last question, you've also touched on it, but maybe make a few additional comments. The question is, how relevant is the current trade war with the US in its effect on real estate demand in China?
I think it do affects because of the tension in between, especially I think, although in Hong Kong and China, it still face the same. As you may already realize, there are always the manufacturing in manufacturing production in China, and then they ship to other countries, and then also import to US. I think about the trade war is especially about the industrial sectors. Although we have a strong industrial and logistics sector in China, but we do have a strong internal demand, but we are also focusing on the external demand, especially about the worldwide and also the US. If there is the tension and the tension is going up, then we are focusing that there will be a strong hold on in the industrial sectors, which will also the spillover effect to both for the retail and office as well as the residential, because it affects the whole economy.
Okay, great. Thanks, Jun. This is also another big topic. People are writing a lot and spending a lot of time. This could be, again,
a lot of time.
A webinar. So thank you very much. And thanks to all the panelists. I think that wraps up the presentations and questions. Thank you very much.
Thank you.
Thank you, Hiro, Sumi, Junior, and Steve. That was a great overview. This is a step forward and a study in contrasts from our last webinar, and a useful guide to anyone looking to examine international markets. We also want to thank the team that makes this international collaboration possible. Larissa Phillips, Cassandra Curio, and RJ Siroy in Chicago, and Mariko Uchiyama in Tokyo worked to coordinate time zones, video formats, and questions to put this together. And also a thank you to the Counselors of Real Estate Foundation, which provided a grant to help with the costs of bringing all of this together. Look for details on upcoming What's Next sessions, including our next that will take us to the Philippines, Indonesia, and Cambodia. And until next time, on behalf of the Counselors of Real Estate, thank you for attending this session of What's Next for Real Estate and the Life Experience.